Hello everyone, welcome to Fearfully Greedy. In today's video, I will talk about how 2024 went for me. And remember, this and all my videos are not to be considered financial advice. Please consult a professional. I'm certainly not your financial advisor. Also, since the last video, I bought 4,000 shares of Naga Corp, which is increasing 50% my position, investing 1,400 euros. Okay, I bought at 289 Hong Kong dollars. Then the portfolio as the 28th of January sits at 103,900 euros with a 53,900 euro gain, 108% up, since July of 2020. I have invested the 50,000 euros across these 4.5 years, and the money weighted rate of return has been close to 30%, mainly driven by Carvana. I had other wins also, but Carvana is a big factor of these wins. There's a link in the description with a Google Sheet where you can see all the live prices, everything I bought ever, all the money additions, all of that. In 2024, I added only 3,000 euros on April, and you can see the deposit here on the Giro. I operate on the Giro, and that's my only addition. At the start I was doing more periodic, like every month additions. Later it was just when I had more cash I would add some money in. In 2024 I did one sale, which is Warrior Met Call, where I sliced the position in half. Half the position was 150 shares, which I sold at a 330% gain. So I made 6,667 euros, and I will be paying 1,280 euros in taxes, which I have not paid yet, but around June I should make that payment. Then in all 2024, I did have one new idea, two old ones, and I bought 6 times, right? The one was Naga Corp, which I also added this year, but that was on January 24. Then I added on Playmates, which was the original purchase of 6,500 euros. Then I added a bit to Ra International, a small add, and then I added to Playmates again. Okay, Playmates I did 2 buys. We could say it's 1 buy, but 2 buys. Okay, 2 buy decisions. And then I added also to Pax Global Technology, a small add also of 1,000 euros, probably from dividends and other things. Let's see this on a graph. I started the year with 48,700 euros, and I finished the year with 89,000 euros. That's 31st of December. Okay. First the sale of Warrior Met Call at the start of the year, then Naga Corp at, Playmates at, that would be still start of the year, and the small addition of Ra International. Middle of the year I added the 30,000 euros, adding more to Playmates, mostly the entire thing to Playmates, and later on I added to Pax, probably from the rest of these and dividends and other stuff. I did one trade every 91 days in 2023. I did one trade every 61 days in 2024. Okay, so I'm becoming worse. I'm doing more trades, which is not the goal. The cash adds accounted for 6.2% of original cash. The dividends added 2.95% to original cash, and depreciation, realized, unrealized, everything. Some of it I pay taxes on, but from start net asset value to end net asset value, I added 73.6% of appreciation. So 2024 was a great year for unrealized most gains. Net asset value evolution, so adding everything up, moved 82.8% in 2024. If we compare to the benchmarks, okay, we have the Standard & Poor's which moved 28.05%, Nasdaq moved 33.28%, and for me it was 73.2%. Okay, this is absolute returns, which I think I should do more money weight, but that year I added very little money, so it doesn't make much of a difference. And this is tracking the lowest cost ETF funds, because just tracking a virtual metric, it will be very close to this, but a virtual metric that means nothing. This ETF that it has the lowest cost in euros that I could buy at the start of the year and sell at the end of the year. In 2024, I started a bit late, but I have looked at 261 companies, from which I just got one new idea, really. I made a mistake here, one new idea, and the others two are from previous year. But for 2025, my goal really is increasing this number. I really want to focus on process over output, just seeing more companies, learning more about companies, about sectors, and just going all in on that. Returns might come, might not come, but I think if I focus on process over the long term, that's a good result. And this since the start of the project, 1,641 days, almost 4.5 years. And this tracking every year for me is money weighted rate of return, and for the S&P and the Nasdaq is time weighted rate of return. So it's just tracking the index of the ETF, right? Invested at the start of the year, sold at the end of the year, and these are the two indexes I track. Okay, it's been good overall. I'm above the indexes. I did this to today mostly money weighted rate of return, real annualized to today. So it's not for 31st of December 2024. It's to today. But I didn't expect this such good returns. As said, most of it is Carvana, or a big part of it is Carvana, but it's the way I invest. Winners will push a lot of positive returns forward. If we compare same money, if I did the same addition on the exact day, I would buy the index, these indexes, right? Every time I added money, I'm 35% over the S&P 500 at the end and 30% over the Nasdaq also. So not too bad. We'll keep looking, see where the next 5 years do, where the 10-year mark is, but bit by bit. I will take also a look at the companies I looked the last days. This normal format for the video where I bring maybe most interesting idea, but then I also bring all the ideas I have looked through the last week. I looked at 44 companies. 13 I just didn't like. We have Upwork, Leaves, just by the logo, I don't know the company exactly. The satellite company that they do like direct to device without addition. Mostly for rural areas. I just find it too hard to have any idea of what the company could be in the future. Too risky, Reddit, and yeah, a couple ideas were a bit too risky for revenue at the moment, leverage, no profits. Maybe I like the idea, but I just think it's so risky. Sometimes here, companies that end up here is they just have one client, something like that. Okay, companies, it's companies that I think I can understand, but I don't think it's anything crazy, or the margins are nothing crazy, their competitive position is nothing crazy, just companies that at a good discount I might buy, right? Then companies that I like is I think they are above competition. They just have something, a moat, a brand, margins, technology, something that is above the rest. And then companies I love, which I think there's very few companies. I don't know. I don't know exactly how many companies I loved, but since we started doing this, but very few fall here. Like Google, like these kind of companies is the ones that fall here. So 20 didn't pass. 22 I invested. So I passed on 20, 22. I think would be investable at a good discount, right? So if we kind of graph it out, so the same number, only investable, the 22 investable, there's just a lot of them that are just not underpriced, right? So if we kind of take a look here, the companies that look better on valuation would be Samsung and SOC, which is Sable Offshore, which is an idea from Lilo, and TSMC just, I don't think it's overpriced. I think it's quite close to priced to normal price, but it's just it doesn't have a discount to current earnings, and the future is a bit unknown. The moat is ridiculous, but not always the cheapest thing is what piques my interest. Sometimes it's something weird, something I don't understand, or something that comes from a very smart person. And this might be a bit weird, and also I think it comes from a smart person. So Lilu is like the prodigy from Munger. I mean, not the prodigy, but like every time Munger would invest in China, he would invest it through Lilu, and they were very good long-term friends. He has a very concentrated portfolio. This is not all his companies, but generally pretty concentrated. And I think he does very good value investing, like in general. He has had some missteps, like I think he won't bought Pinduoduo at a ill timed or other things, but Sable Offshore Corp said, well, he just added to the stock in let's see when. Well, he owns 1.51% of the company, 37 million. If we saw it was 2.4 billion, his portfolios just US, so it's not a big position, but it seems a bit weird. Like, why would he go for this kind of company? Of course, we know Buffett has been going through to oil, to other things, so maybe it's an idea kind of for coming off that. Also from the elections, there's some of that. He bought at around I think $23, $24. At at the moment is at 27.83. Okay, so it has not moved that much, but a bit. I said this might come from the election as Trump is going back to the drill baby drill, like from the 2008 or whenever that happened. So maybe it's a play of that. Let's see why he picked this exact company. Then enterprise value is around 3,000 million, so 3 billion, right? Dollars. And if you see there's a lot of empty slots here, that's because the company at the moment is not operational. So they bought an asset that was paused in 2015. So what it is exactly? So it's in the Santa Barbara Canal, right? And it's three platforms that they just pump oil from the seafloor, right? If you see, it includes 112 wells, 19 producers, 12 injectors, 10 idle. I will also say that I have no idea of offshore drilling and offshore oil, so I will learn some with you. It's just something that when I hear oil, it something in me tells me no, so I've never delved into a lot. So, but let's do some number. Let's see if this is at all can be at all interesting. Originally, it was from Exxon from like the 60s. Like it was discovered, I think, in the 50s, 60s, and then they operated it for many years. And at some point, there was an accident. So in 2015, there was a oil spillage, like one of the how do you say one of the pipelines exploded, and it was like a big fiasco. They forced them to close. It was mainly from another company, the mistake, but they just closed the operation since then. So almost a year without operation. In February 2024, Sable Offshore Corp kind of acquired it. It come from SPAC, right? And they acquired this asset from ExxonMobil Corp, thinking they could get it back to operation. Still, this has not happened. What surprises me is that Lelo, I don't think he invests a lot in things that there's so much unknown. Like even for oil, that you invest in it and it's cheap generally because people don't want to touch it so much. This one is there's a lot of unknown. Let's see if the price there's that potential. It's unknown, but it was operational for many years, so maybe that there's some safety net. But there was a huge spillage, and after 10 years of no operation, I don't know how the things are. Management say it's good, but okay, let's take a look. Okay, remember 3 billion. Okay, the company sells for 3 billion. So we can see that between 1981 and 2014, the production average per day, right, this day, is 29 million of barrels oil and cubic feet of gas, right, to 26 million. This 29,000 is 26 million cubic feet of gas per day, right? We'll do some numbers in a second, but there's maybe 100 additional possible infill development step out from the platform. So there may be some growth, possible growth. The resources amount to 646 million equivalent barrels, right? And there's the oil column remaining under it. I said I don't have the most idea, but let's think that this is kind of where they are, and there might be 646 more resources. Also, if you know more about this, please comment. I'm happy to learn. Not maybe, probably not a sector I will ever invest, but it doesn't hurt to know more. But also know that this kind of production tends to decline 8% a year on average. So probably it started very high and it keeps going down, down, down. So unless they find ways to expand, revenues will go down, down, down. They are at zero, but they will start at a place probably around here, but it will keep going down, down, down. Okay, how much is that? 29,000 barrels a day or 27 million cubic feet of gas. If I go for pricing, this is probably wrong. This is not probably not the right way to do it, but I think you get some rough numbers because I want to see this completely cheap unless I'm very, very against buying this. I made a guess that crude oil is around $73. I think that's a safe guess today. And tomorrow, no one knows, right? But it's been increasing in price for the last 30, 40 years, maybe 100 years. Crude oil has been increasing in price, right? So I don't think it's going down, but oil, we have been trying to move out of oil, which is another thing. Then if we take a look at natural gas, there was a good spikes in 2020, right? As we remember, but now it sits at $3.6 per thousand cubic feet, which if we do the math, it's at today's prices, I think revenues maximum should be around 774 million dollars for the oil, 35.5 million of gas, right? If I did the math wrong and this all together, I think this is correct, but let me know if it's wrong. So now I know the revenue. The revenue, okay, if we remember, 3 billion revenue might be 800 million. So unless margins are very high, this doesn't look like super cheap at this point, right? From the previous production. Also, we should know cost. If you know a lot of these resources, even with coal, I have a company in coal, but there's different mines, or there's different dwells, or there's different offshore operations that they have different break-even costs. And when oil is below that, they tend to be shut off because you're losing money. You're working and losing money. And you could wait until the prices go up and then make money at that point. Same here. So we want to know what's the break-even of this operation. I've tried to look for company data, but I couldn't find anything. I tried to make an educated guess. This cumulative US oil production break-even oil price, right? Kind of like what would be the break-even. And if you see, and from other research, other magazines and things I looked around, I try to guess that it's between 30 and 60. Depends on the operation. Offshore tends to be much more, well, a bit more expensive than onshore, of course, inland. And it also comes with the Las Flores Canyon cogeneration and processing facility. So this should add some extra margin, right? It's not just they are selling the crude thing, they are kind of refining some of it, not refining, but maybe processing some of it, and some cogeneration. So this might add more margin than other operations. But I think this is a pretty standard thing to have, right? Fully integrated oil and gas processing facilities acquired by Sable for managing 100% of the produced volumes with additional capacity for future development. Gas and natural gas volumes sold into the Southern California market to homes and business, and oil volume sold to Brent. So probably Brent is the kind of average correct price gauge. Sable management believes that the facilities have been well maintained during the downtime. I would like some photos. I would like them to be maybe a bit more open about it because this is closed at the moment. This is not running, so we have no idea if something will break just by at the start. And this is something that already me at this point it would be pushing me out of the idea. We don't know really what the cost will be when we start. We don't know if some things have to be replaced exactly. Okay, the management has a long track record, but they don't know if any pipes need to be replaced. We don't know exact cost. Okay, this is some of the map where they are. This is federal land, and they are like on a list that can be repeated unless something happened. Like in 2015, it happened. And then they have identified what it is, like 102 total opportunities to do some expansion, to do step out drilling opportunities, gate step out offset. I have no idea what this means. Sorry, but there might be opportunities to grow this. But if we take a look here, even with their kind of assumptions, because if this is going up, they think they will be able to do some of these other drills, other holes to increase the production that is going down through the normal 8% decline. So if this is going up and this goes way above what we saw historically, they assume they will get some of the extra things working. That's just logic, right? And here we can see some of the capex. We don't know cost opex, but we can add up a bit the capex. I did some numbers. So I did adding all the 10 years of production will be 166 million equivalent of barrels of oil, right? Total, right? At current pricing, $73. Let's take that number. We could take any other number, but let's take that one. That's 12.2 billion. If we could say all of this today, okay? I have not discounted anything, which that's an important thing also. Capex is, if we add all these bars up, is around 1.6 billion, 1.7 billion. Depends, or we don't know exactly where this is or this is. I could maybe do it more exact, but 1.7 billion, 1.6 billion, whatever number you like. Still no idea on OPEX, but my guess would be at least around the $47, including the 16% royalty that I've seen some numbers in the data. Adding all of this up means that they profit $26 per barrel today, which we don't know the future price of Brent or crude, but that's the number. Total gross profit would be 4 billion, 4.3 billion. These very rough numbers. Remember, we're paying 3 today without discounts. Or my math is very wrong, or this doesn't make a lot of sense as an investment. Maybe it's very safe, low yield investment because you are getting like an extra billion in 10 years, but I don't know. It doesn't seem like crazy numbers. Well, and I didn't subtract capex, so 2.6 billion, and we're paying 3 billion including debt. So probably I did something wrong, which I would like you to tell me why this project has more opportunity that I'm seeing, because if Lilu invested, probably there's something else. But this is what pushes me away. I think the numbers are not crazy good to be just pulling in money into this. This is kind of the valuation they are doing. Like this is mostly for the contingent resources, which I think is the extra resources that they could add to the current resources. I think that's the thing. And then the PV10 is like the present value of this. And this very standardized, like the SEC, that's kind of this value, but it tends to be usually above what it ends up being. Generally, we're generalizing. But this is a very standard, like core present value of all of the resources net of cost, so including the cost. And 2.3 billion of capex. So the capex might be higher. Well, because this is the extra things. Okay. But they also, in the assumptions, they were increasing production. So probably this is closer to the capex, which then my numbers would be worse. But keep in mind these 10 years at their projection rates, it takes, if we take their, what was it, like 26,000 barrels a day or close to 50,000 barrels a day, I'm accepting these numbers. If we take these numbers with the resources and the pending resources, to take out the 646 equivalent million barrels of oil out of the sea, it will take them around 40 years. If we discount the current money, unless future price of oil is much higher, I don't think it makes a lot of sense. And probably there will be more supply at this moment. So to me, I'm starting to think I will pass on this. Without take, I said, also there's a slowdown of production. So every year you take 8% less or 9% less, depends what number you want. So this is not getting me excited. That's what I will say. They do some numbers. There's also some debt, like 800 million of debt, which puts it even in a worse position. And then they say that the large base production and then probably good growth, they say this is low, like this decline, but knowing that your revenues will decline with time, not maybe revenues, but your production declines with time, is not a business that sounds very appealing to me. I don't know why to the Lulu it does, but not to me. And then they say that there's 2.1 times current enterprise value to the PB10, right? And 18% discount to peers on some metrics of adjusted low estimated base forecast of resources dollar per barrel, right? This is a very little discount for me to be investing in something that I just think mathematically is 18% more cheap than other things. I want to see that it's 100% more cheap, at least. Okay, so just to finish off, at this point I decided to pass based on a risk adjusted potential of the idea. I don't think there's enough money to justify all the risk in this idea. Project has been paused for 10 years. Oil also has a bad press. Maybe the current government doesn't think that, but overall in the world, bad press. And in the future, yes. The, there's a good new government, so I will take that as a good thing. But also the risk is that that could change. Like in 4 years, someone will start maybe to stop all these operations and will be with nothing at the end. Also, offshore is way riskier than onshore. Also, of course, there's less of that, and like frac and other things are even worse, but it has pretty higher break-even costs. So it's riskier, higher break-even, more investment. Okay, the project is there, but we don't know exactly how it looks really. I will keep an eye on this because I want to see what the real numbers end up being and how wrong I am at the moment from that, right? And I say it is oil, and I tend to, there's some sectors that I just don't want to get into unless the numbers are ridiculous, which I think they are not. Okay, I will keep looking for things. I'm currently looking at a bit of airlines, just delving my feet in. I don't think I will invest in it, but I'm doing a bit of a sector research on airlines. See what I like. Okay. Well, I will keep you posted. See you soon. Take care. Bye bye.